a fifth-generation fighter jet, an electric vehicle battery array, a high-density data center. These technologies rely on a specific basket of materials, namely critical minerals like lithium, cobalt, and rare earth elements. In 2024, the global energy transition pushed demand for lithium alone up nearly 30%. When policymakers discuss securing these supply chains, the focus usually defaults to extraction, locating deposits and digging ore out of the ground. But extraction is merely a distributed commodity. The actual geopolitical choke point sits one step further down the line, in midstream refining. The actual chemical transformation from raw dirt to technology-grade metals is where the technical and economic leverage actually resides. Looking closely at physical extraction, mining is geographically distributed. You find operations scaling massive open pits across Australia, the Democratic Republic of Congo, and Indonesia. But turning that ore into something usable requires a highly localized, sprawling industrial infrastructure. This creates a strict disconnect. A high volume of global mining output does not equal supply security. Raw ore is functionally useless on its own. It requires intensive metallurgical processing to achieve the exact purity needed for advanced technology. This technical and chemical layer of the supply chain is midstream metallurgy. A nation can source raw lithium or cobalt from close allies, but if the midstream metallurgy is outsourced, the entire supply chain remains vulnerable to disruption. Billions of dollars spent on Western mining investments yield little strategic value without the high-tech refining capacity to process the material domestically. This chart maps the bottleneck. China is the dominant refiner for 19 of 20 strategic minerals. Facilities there process 95% of battery-grade graphite, 85% of cobalt, and 60% of lithium. Since 2020, 90% of refined supply growth came exclusively from China. To see how this dictates trade, look at the material flow. Ore originating globally funnels directly into a massive processing node in China, then exports as refined material. Even Western extracted raw lithium is shipped to Chinese facilities because alternative processing infrastructure simply does not exist at scale. Beijing achieved this position through decades of state-backed vertical integration, subsidies, and over $120 billion spent acquiring overseas upstream assets since 2023. The origins of global minerals appear diverse, but mathematically they converge into a single point of failure supply chain. The sharpest edge of this vulnerability is in defense applications, specifically regarding heavy rare earth elements. China refines nearly 99% of heavy rare earths, translating directly into the production of 94% of the world's centered permanent magnets. Without these highly specific, processed magnets, platforms like nuclear submarines and fighter jets cannot operate. The 2026 U.S. Geological Survey confirms the United States relies on China for 70% of its rare earth imports and remains entirely import-dependent for many other critical minerals. This monopoly is actively weaponized. In December 2024, Beijing banned the export of gallium, germanium, and antimony to the U.S. In 2025, those controls expanded to target medium and heavy rare earths in direct response to U.S. technology sanctions. These export licenses operate as engineered scarcity, functioning as a lever of influence in great power competition. By monopolizing the midstream, a single nation can throttle the defense production lines of its geopolitical rivals at will. Projecting this trajectory forward to 2035 reveals the limits of current Western policy. Forecasting models from the IEA show an aggressively upward-sloping demand curve, driven by both the green energy transition and defense modernization. Against that demand, the curve for non-China refining capacity remains dangerously flat. The widening space between these two lines is the 2035 structural deficit. Under current projections, alternative supply pipelines will cover only about half of the required battery metals and rare earth elements needed by 2035. Even standard industrial metals like copper face a projected 30% shortfall. Western attempts at diversification are crawling. New processing projects face high capital costs, decade-long timelines, and stringent environmental hurdles. Domestic recycling is often cited as a solution, yet China already accounts for 2/3 of global battery recycling capacity growth. The math indicates that current policies of friendshoring will leave the midstream gap open well into the 2030s. This deficit translates directly into global economic fallout. The market faces massive price volatility, with projections indicating that EV battery costs could jump 40 to 50% outside of China. That level of cost volatility threatens to stall large-scale clean energy rollouts and infrastructure projects across Western nations. Global markets will fragment as resource nationalism increases and nations scramble to secure localized processing quotas. Achieving true supply chain resilience requires massive, accelerated capital expenditure in domestic metallurgy. Extraction alone leaves the final value add in foreign hands. The critical minerals crisis is a policy-driven scarcity, engineered over decades for strategic advantage, rather than a natural geological shortage. Failing to build the necessary midstream infrastructure equates to accepting long-term vulnerability. It means paying the price in lost autonomy and ceding control over the core components of the energy transition.